Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Saturday, everybody. I hope you're having a restful weekend. Today's video will be focused on trade and the global trading system, and we will begin by moving through the salient developments in EU-China relations from this week as tensions in trade, as well as security, continue to deepen. We covered NATO turning its sights towards China in yesterday's video, so we will not repeat that coverage today. On Wednesday, China's Ministry of Commerce announced that it has launched a trade and investment barrier investigation into the EU's foreign subsidy investigations, saying that it is responding to an application from the China Chamber of Commerce for import and export of machinery and electronic products to initiate the investigation. This is obviously in response to the EU's recent tariff announcement against Chinese EVs, along with other probes across different industries. That is a counter-offensive in the deepening trade war between the two sides. The investigation will look at the EU's recent actions against Chinese companies. The June application by the China Chamber of Commerce for import and export of machinery and electronic products mainly involves products such as rolling stock, wind power, and security inspection equipment. The ministry plans to complete the investigation by the 10th of January of next year, with an extension to the 10th of April in exceptional circumstances. Cui Hongjian, a professor at Beijing Foreign Studies University's Academy of Regional and Global Governance, told state-run Global Times on Wednesday, quote, "Launching the investigation is a move by Chinese authorities to protect the legitimate rights and interests of Chinese enterprises, as in some of the EU's so-called investigation and evidence collection process. We also see that Europe is now reflecting a stronger unilateralism, which violates the rules of the WTO." End quote. Zhao Junjie, a research fellow at the Chinese Academy of Social Sciences Institute of European Studies, speaking to the same outlet, sought to paint the trade friction as being solely the fault of the Europeans, expressing, quote, "Europe is now facing a series of economic and social crises, including inflation, energy shortages, and rising prices for raw materials. So it's abusing trade protection measures, including setting tariff barriers to protect its increasingly hollowed-out manufacturing industries," end quote, adding that neoliberalism, quote, "has failed," end quote, and now the bloc is turning to, quote, "neoconservatism," end quote, which may be even more damaging to its economy. Of course, this argument ignores the fact that most major economies from the developed and developing world, the US, the EU, Japan, India, Brazil, Indonesia, Turkey, and others, have in recent months all implemented protectionist measures, not against the world generally, but against China specifically. Meanwhile, probes and protectionist moves march forward in the EU. Chinese wind turbine companies in Germany are being investigated for state subsidies after EU authorities expanded an existing investigation to include Europe's biggest economy. It comes under the European Commission's Foreign Subsidies Regulation, a competition tool designed to ferret out state handouts on the books of foreign companies operating within the EU's single market. Also, this week, US-based The Wall Street Journal reported, citing unnamed sources, that under a draft agreement with the government, Germany's main telecoms operators have agreed to remove components made by Chinese manufacturers Huawei and ZTE from their core networks, the most sensitive part of a mobile network, by the end of 2026. The network management system in the radio access networks, the software that handles communication between devices on a wireless network, should be free of Chinese components by the end of 2029. The market seems to know which way the wind is blowing too. In a Wednesday note, a group of Goldman Sachs strategists advised that investors should sell European stocks that derive the bulk of their sales from China due to sluggish consumption and heightened trade tensions. The strategists warned of poor spending appetite in China, the country's intention to tax luxury goods, and the likelihood that Beijing would retaliate against the European Union's tariff hike on electric vehicle imports. The note expressed, quote, "While a great deal of earnings downgrades have already occurred year to date for our luxury basket, we worry that more could take place. Also, the valuation premium of the basket has deflated, but remains on the high side of its history." End quote. Meanwhile, we also saw friction in the security space this week too. On Friday, the EU issued a statement to mark the 8th anniversary of arbitration on the South China Sea's sovereignty, which was in the Philippines' favor. The Chinese mission to the European Union said it was strongly dissatisfied with and resolutely opposed to the statement, saying the bloc ignored historical and objective facts of the issue and, quote, blatantly endorsed, end quote, what it called the Philippines' violation of its sovereignty. China rejects the 2016 ruling by the Permanent Court of Arbitration in The Hague that Beijing's expansive claims over the South China Sea had no basis under international law. The case was brought to the court by the Philippines. The US State Department on Thursday issued its own statement to mark the 2016 ruling. So, these are the trade and security tensions in the bilateral relationship from this week, and as we will see with the third story for today, the former at least, trade, is set to be further exacerbated. But first, let's have a quick reminder of what is meant when officials in the West and other places accuse China of overcapacity. A nice, concise description of this came from the Undersecretary for International Affairs with the US Department of the Treasury this week. Let's quickly look at it before moving to part 3. Quote, overcapacity concerns and interventions are not new, but we are seeing a resurgence of risks in new sectors. Earlier rounds of overcapacity led to job losses in the United States and shuttered American firms. Given China's size today, spillovers from its economy will be even more consequential. That is why today I want to discuss what overcapacity is, what Chinese policies cause it, where are we seeing it, the potential global spillovers, and how we should respond. Chinese policymakers' clear preference today is to push manufacturing even further as China's growth driver, which means taking on an increasingly outsized share of global production, with other countries' manufacturing sectors needing to shrink to compensate. China's size means that its imbalances pose an even greater risk to the global economy. A small economy exports at the world price, but a large one, especially with a dominant market position, can shift global prices and leave the rest of the world to deal with the consequences. When Chinese production is growing faster than its own demand or that of the global economy, the rest of the world cannot absorb China's increase in manufacturing production without being forced to adjust. These conditions would not appear in a normal market economy. What we are seeing is a fundamental distortion, driven by government policy. But what do we as policymakers mean when we talk about Chinese overcapacity? Defined most simply, it is production capacity in excess of domestic demand and untethered from global demand, and we are concerned about the pattern of overinvestment and state support driving it. While periodic surpluses can occur within the natural business cycles, we are concerned about structural overcapacity, which stems from persistent patterns of overinvestment and is facilitated by extensive state support. We are not isolated in seeking to address negative spillovers from China's non-market practices. The EU and Turkey have also recently imposed tariffs on Chinese EV imports. Mexico, Chile, and Brazil have taken trade actions on Chinese steel, and India uses tariffs and other trade tools to defend its solar manufacturers from Chinese dumping. And while each country had their own concerns and needs, the underlying reason is undeniable. As the G7 leaders and finance ministers have stated, Chinese overcapacity undermines our workers, industries, and economic resilience and security. The United States will act, and we won't be alone. End quote. Next up, we have one more part to cover for today, but just quickly, if you're getting some value from today's episode, don't forget to hit the like button. Sharing and subscribing is a big help too. The channel is about to hit 71,000 subscribers, which would be great to hit. Patreon and Buy Me a Coffee links are also in the description below for those who want to help keep the channel financially sustainable. Thank you so much. According to official numbers, which are generally reliable because they can be verified with trade partners, published by the General Administration of Customs yesterday, Friday, China's exports grew more than expected in June, while imports fell unexpectedly in another sign of weak domestic demand. In June, outbound shipments soared to $308 billion, an 8.6% jump from a year earlier, and up from May's 7.6% increase. Imports dropped 2.3% in June to $209 billion, much worse than the 1.8% increase in May, and well below expectations. This has resulted in a record trade surplus high last month, raising the risk of US and Europe stepping up efforts to shield their markets from Beijing. Indeed, global criticism and accusations of overcapacity stem from a subsidized supply side and weak demand, which is exactly what these data would suggest. China's surpluses with the EU and the US hit their highest levels since January and September 2023, respectively. Imports from Japan fell almost 11%, and purchases from the US, Canada, Asia, the EU, Australia, Brazil, and Russia also declined. Bruce Peng, chief economist for Greater China at Jones Lang LaSalle Inc., expressed on the numbers, quote, "The record surplus could also provide some fuel to those quick to pass judgment on China's manufacturing overcapacity and perceived dumping to bolster trade." End quote. Zhang Zhiwei, head of Pinpoint Asset Management, observed, quote, the trade data reflects the economic condition in China, with weak domestic demand and strong production capacity relying on exports." End quote, adding, quote, "The sustainability of strong exports is a major risk for China's economy in the second half of the year. The economy in the US is weakening. Trade conflicts are getting worse." End quote. China saw a $99 billion trade surplus last month, the highest monthly surplus ever recorded. Exports to the European Union, China's second-largest trading partner, rose 4.1% in June, reversing a 1% decline in May. Shipments to the US, China's number 3 trading partner, climbed 6.6%, accelerating from a 3.6% increase in May. Export growth to the Association of Southeast Asian Nations, China's biggest trade partner, slowed to 15% in June from 22.5% in May. Eric Zhu, a Bloomberg economist, expressed on the numbers, quote, "A second straight month of stronger than expected increases in China's exports in June points to some upside risk to second quarter GDP data due Monday. Firm external demand and favorable base effects will likely continue to support shipments in Q3 of this year. Even so, that wouldn't put the recovery on a sound footing. An unexpected drop in June imports shows domestic demand remains weak. To achieve the official 5% growth target, quicker and bolder stimulus will be needed." End quote. But we will leave the last comment to Professor Michael Pettis of Peking University. Quote, "Exports may have been boosted by Chinese manufacturing deliveries aimed at beating potential tariff increases, but the latest trade numbers were terribly unbalanced, with June's trade surplus, $99 billion, the highest monthly surplus ever recorded. While exports in June were up 8.6% year-on-year, imports were actually down 2.3%, which I find a little shocking. I generally expect import growth to be weaker than export growth because, for all its talk about trying to boost consumption, China has been extremely ineffectual in raising domestic demand, as we saw earlier this week in China's continued CPI deflation. But I didn't expect imports to do so badly when exports did so well. China's dependence on the rest of the world to resolve its domestic demand weakness is rising, even as it becomes more difficult for a more reluctant rest of the world to play this role. Expect global trade relations to continue to deteriorate." End quote. Thus, we may be seeing the beginning of the end of the globalized trade system. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a great Saturday, have a restful weekend, and I will see you all on Monday.